Something fundamental has shifted in the silver market. If you're watching this, you've likely noticed. Silver recently crossed $91 per ounce, a threshold many thought impossible just months ago. But this isn't about a single price point. It's about what that price represents. We are witnessing the early stages of what may be one of the most significant wealth transfers in modern financial history. Not because of speculation, not because of hype, but because structural forces decades in their making are now converging in ways that cannot be ignored. I'm speaking to you today as someone who has watched markets for years, who has seen cycles come and go, and who understands that real wealth is built on understanding, not excitement. If you already hold silver, this moment requires clear thinking. If you don't, this moment requires education before action. What you're about to hear won't be sensational. It will be measured. It will be based on evidence. And it will help you understand why this particular moment in financial history deserves your attention. Let's start with what's real. Silver has broken through price levels that have acted as resistance for years. This isn't a one-day spike. This is a sustained move accompanied by changes in market structure that tell us something deeper is happening. Physical silver markets are showing signs of stress. Premiums at dealers have widened. Delivery times have extended. These aren't abstract metrics. They are symptoms of supply struggling to meet demand at a time when above-ground inventories are already historically thin. At the same time, industrial demand for silver continues to accelerate. Solar panel production alone requires more silver now than entire national mints did a decade ago. Electric vehicles, 5G infrastructure, medical applications, all of these consume silver in ways that didn't exist at scale before. But here's what most people miss. The price movement we're seeing isn't just about supply and demand for a metal. It's about confidence in currency itself. When you zoom out, you see patterns that can't be dismissed. Global debt has reached levels that would have seemed impossible to previous generations. The United States alone carries debt obligations that exceed annual economic output by multiples. Other major economies face similar challenges. This debt must be serviced. And historically, when debt becomes unsustainable, governments have two choices: default or debase. Defaulting destroys credibility. Debasing destroys purchasing power. Neither is pleasant, but one is politically survivable. Central banks around the world have spent years suppressing interest rates and expanding money supplies. This wasn't secret. It was policy. The stated goal was to stimulate growth and manage crises. The unstated consequence was the systematic erosion of currency value. You've felt this even if you haven't named it. The grocery bill that keeps rising. The rent that never seems to stabilize. The sense that a dollar doesn't stretch as far as it used to. That's not your imagination. That's monetary policy expressing itself in your daily life. Silver, like gold, has served as a store of value for thousands of years precisely because it cannot be printed. Its supply is limited by geology and mining economics. When confidence in paper currency weakens, hard assets historically attract capital. We are not in theoretical territory anymore. We are watching it happen. The average investor has been conditioned to think of metals as relics. Barbarous relics, as one famous economist called gold. The financial media has spent decades reinforcing the idea that stocks, bonds, and real estate are the only serious asset classes. This conditioning runs deep. It's why many people still view silver as something bought by conspiracy theorists or doomsday preppers. They miss the institutional buy-in. They miss the sovereign wealth funds quietly accumulating. They miss the smart money that never announces its moves. There's also a fundamental misunderstanding about what drives silver prices. Many people think it's purely about industrial demand or jewelry. They don't realize that silver's monetary heritage becomes relevant during periods of currency instability. Throughout history, When paper money loses credibility, people return to tangible assets. This happened in Weimar Germany. It happened in Zimbabwe. It happened in Argentina. The specifics differ, but the pattern is consistent. Most people also confuse volatility with risk. Yes, silver is volatile. Its price can swing dramatically, but volatility and risk are not the same thing. Holding an asset that fluctuates but preserves purchasing power over time is fundamentally different from holding an asset that steadily loses value in real terms. We have historical precedent for what happens when monetary conditions reach extremes. The 1970s offer the most recent parallel in developed economies. Inflation accelerated, real interest rates turned negative, and precious metals entered a bull market that lasted nearly a decade. Silver went from under $2 per ounce in 1971 to over $50 by 1980. That's not a projection for today. It's a reference point for understanding how these markets can move when fundamental conditions align. What drove that move? A combination of monetary expansion, geopolitical instability, inflation that central banks couldn't control, and ultimately a loss of faith in the purchasing power of fiat currency. We see similar conditions forming today, but with important differences. The debt levels now are far higher. The money printing has been far more aggressive. The financial system is far more interconnected and complex. And the industrial demand for silver is far greater than it was 50 years ago. Markets don't move in straight lines. They cycle. They correct. They frustrate both bulls and bears. But when the underlying fundamentals remain intact, the trend eventually reasserts itself. What we're seeing in silver isn't just technical chart patterns. It's the market slowly coming to terms with realities that have been building for years. If you've been holding silver, you're likely experiencing a mix of vindication and uncertainty. The price move validates your thesis, but now you're asking yourself what comes next. First, understand that you've already done the hardest part. You accumulated when it was unpopular. You held when others dismissed you. You endured periods when the price seemed dead. That discipline has positioned you for what's unfolding now. Your focus now should be on maintaining that discipline. This is where many investors make critical mistakes. They see gains and either panic sell too early or become overconfident and overexpose themselves further. Remember why you bought silver in the first place. If it was for wealth preservation during monetary instability, that reason hasn't changed. In fact, it's becoming more relevant. If it was for portfolio diversification, that function is still being served. Don't let short-term price movements dictate your strategy. Silver will have corrections. It will have moments that test your conviction. What matters is whether the underlying thesis remains intact. Ask yourself, has global debt decreased? Have central banks stopped money creation? Has confidence in currency strengthened? If the answers are no, then the fundamental case for holding silver hasn't weakened, it's strengthened. That doesn't mean you should never take profits. Risk management is personal. If you need liquidity for life expenses, that's rational. If you want to rebalance, that's prudent. But don't let fear or greed make those decisions for you. The wealth transfer happening now rewards those who understand cycles and maintain perspective. Your task is to stay informed, stay rational, and avoid the emotional extremes that destroy portfolios. If you haven't bought silver yet, you're likely feeling two competing emotions: regret at missing earlier prices and urgency to buy now before prices go higher. Let me be direct. Both emotions can lead to poor decisions. First, understand that this move is likely in its early stages. These structural forces driving it didn't appear overnight, and they won't disappear overnight. You haven't missed the entire opportunity, but that doesn't mean you should rush in blindly. Education must come before action. You need to understand what you're buying and why. Silver isn't a stock with earnings growth. It's not a bond with yield. It's a tangible asset with unique characteristics. If you don't understand those characteristics, you'll panic at the first correction. Start by asking yourself why you're considering silver. Is it because you understand monetary history? Is it because you want protection against currency debasement? Is it because you recognize the supply-demand fundamentals? Or is it because you saw the price moving and you're afraid of missing out? That distinction matters enormously. The first set of reasons creates a foundation for disciplined investing. The second set creates a foundation for regret. If you do decide to allocate capital to silver, do it systematically. Don't go all in at current prices. Average in over time. Accept that you might buy some at higher prices and some at lower prices. What matters is building a position that you can hold through volatility. Understand the form silver takes. Physical coins and bars give you direct ownership, but come with storage and liquidity considerations. ETFs provide exposure, but introduce counterparty risk. Mining stocks offer leverage, but add company-specific risk. Each form serves different purposes for different investors. There's no universal right answer. There's only what makes sense for your situation, your risk tolerance, and your goals. And critically, don't let silver dominate your portfolio just because it's moving. Diversification exists for a reason. Even the strongest thesis can be wrong. Even the best assets can underperform for extended periods. Wealth transfers don't announce themselves with headlines. They happen quietly, over time, while most people are focused elsewhere. The people who benefit from wealth transfers are really the masses. They're the individuals who saw the shift coming, positioned themselves early, and had the emotional fortitude to hold through uncertainty. This isn't about intelligence. It's about psychology. The average investor is wired to chase performance and flee losses. They buy high because rising prices create confidence. They sell low because falling prices create fear. This pattern repeats across every asset class and every market cycle. It's why most people underperform the very markets they invest in. Breaking this pattern requires self-awareness. You must recognize when your decisions are being driven by emotion rather than analysis. You must develop the ability to be greedy when others are fearful and fearful when others are greedy. Right now, we're in a transitional phase. Silver has moved enough to attract attention, but not enough to create euphoria. This is actually the most dangerous time psychologically. Prices are high enough to create FOMO, but not high enough to create obvious bubble conditions. The investors who navigate this well will be those who maintain perspective. They'll remember that markets cycle. They'll remember that corrections are normal. They'll remember that their time frame is measured in years, not weeks. The investors who struggle will be those who let recent price action dictate their strategy. They'll buy at peaks out of excitement. They'll sell at troughs out of fear. They'll repeat the same mistakes that have destroyed wealth for generations. One of the most underappreciated aspects of the current environment is what's happening with interest rates and government debt. Governments around the world are caught in a trap. Debt levels require low interest rates to be serviceable, but inflation requires high interest rates to be controlled. You can't satisfy both conditions simultaneously. We've watched central banks attempt to navigate this impossible situation. They raised rates to fight inflation, but not as high as historical precedent would suggest they should. Why? Because higher rates would make debt costs unbearable. Now we're seeing the consequences. Inflation hasn't been defeated, it's been temporarily suppressed. The underlying drivers, monetary expansion, supply constraints, energy costs remain in place. At the same time, real interest rates remain negative in many cases. When the interest you earn on savings is less than the rate of inflation, you're losing purchasing power by holding cash. This creates a powerful incentive to move capital into assets that preserve value. Real estate, stocks, commodities, and yes, precious metals. Silver becomes particularly interesting in this environment because it's both an industrial commodity and a monetary metal. It benefits from economic growth through industrial demand, and it benefits from monetary instability through investment demand. This dual nature gives it characteristics that few other assets possess. Let me be very clear about the mistakes you should avoid in this environment. Don't react emotionally to daily price movements. Silver will be volatile. There will be days when it drops 5%. There will be weeks when it seems to do nothing. None of that changes the underlying fundamentals. Don't over-leverage. The temptation when an asset is moving is to use margin, options, or other forms of leverage to amplify returns. This is how people destroy themselves. Leverage turns volatility into liquidation. Don't chase headlines. Every day you'll see articles predicting where silver is going. Some will say $150. Some will say $200. Some will say it's about to crash. Ignore all of them. No one knows the exact path prices will take. Don't follow influencers blindly. Social media is filled with people claiming to have all the answers. Some are well-intentioned but wrong. Others are deliberately misleading. Your capital is your responsibility. No one else will bear the consequences of your decisions. Don't forget about taxes and transaction costs. Every trade you make has costs. Every gain you realize may have tax implications. Factor these into your decision-making. Don't ignore your personal financial situation. Silver might be the best performing asset in a world, but if you have high-interest debt or no emergency fund, your priorities should be elsewhere first. And don't assume this trend will be smooth. Bull markets are characterized by painful corrections that shake out weak hands. If you can't handle a 30% pullback without selling in panic, you shouldn't be in the position to begin with. While much attention focuses on silver's monetary aspects, we cannot ignore the industrial side of the equation. Silver is the most electrically conductive element, the most thermally conductive metal, the most reflective metal. These aren't trivial properties. They're the reason silver appears in so many critical technologies. Solar panels rely on silver for conductivity. Each panel contains a small amount, but global solar installations are growing exponentially. The Silver Institute estimates that solar demand alone could consume a significant portion of annual silver production within a few years. Electric vehicles use substantially more silver than traditional cars. From battery systems to electronics to charging infrastructure, the electrification of transport is a tailwind for silver demand that will last decades. 5G networks require more silver per installation than previous generation networks. As this infrastructure rolls out globally, it represents sustained industrial demand. Medical applications continue to expand. Silver's antimicrobial properties make it valuable in everything from wound dressings to medical devices. What's crucial to understand is that industrial demand for silver is largely price inelastic. A solar panel manufacturer doesn't stop buying silver because the price went up 10%. The amount used per panel is small enough that it doesn't change the economics. They need the silver, so they buy it. This creates a floor under demand that didn't exist in previous silver bull markets. In the 1970s and early 1980s, silver demand was primarily monetary and photographic. Photography disappeared with digital cameras, but it's been more than replaced by these newer industrial applications. The combination of monetary demand driven by currency concerns and industrial demand driven by technology creates a fundamental supply-demand picture that's historically rare. On the supply side, the picture is equally compelling but more complex than most realize. Primary silver mines are relatively rare. Most silver comes as a byproduct of copper, zinc, lead, and gold mining. This means silver supply doesn't respond to price signals the way pure play commodities do. If the price of copper doubles, mining companies might increase copper production, but the silver that comes with it is incidental. They're not making decisions based on silver prices. The supply inelasticity means that even substantial price increases don't necessarily bring meaningful new supply to market quickly. Opening a new mine takes years of exploration, permitting, and construction. Above-ground inventories are another factor. Unlike gold, which is largely hoarded, silver gets consumed. It's used in industrial applications and often not recovered. This means the available above-ground supply is far smaller relative to annual production than most people realize. Exchange inventories have been declining. COMEX warehouse stocks, which represent one of the most visible pools of available silver, have fallen significantly. This isn't secret information, but it's information that most market participants haven't fully absorbed yet. Recycling provides some supply, but it's limited. Unlike gold jewelry, which can be easily melted down, silver and solar panels and electronics is difficult and expensive to recover. Much of it effectively leaves the supply chain permanently. Add all these factors together, and you have a market where demand is growing from multiple sources while supply is constrained by structural factors that can't be quickly resolved. The investors who succeed through major market shifts share certain characteristics. They're worth understanding because these characteristics can be developed. First, they think in probabilities, not certainties. They don't say silver will definitely reach $150. They say, given current conditions, the probability of significantly higher prices seems greater than the probability of a return to $20. This mindset allows them to make decisions under uncertainty without requiring perfect information. Second, they separate information from noise. Every day brings a flood of news, opinions, and predictions. Disciplined investors have frameworks for determining what matters and what doesn't. They focus on fundamentals, not short-term sentiment. Third, they manage risk rather than avoid it. They understand that all investing involves uncertainty. Their goal isn't to eliminate risk, but to take calculated risks with asymmetric upside. Fourth, they maintain emotional equilibrium. They don't get euphoric when prices rise or despondent when prices fall. They understand that volatility is the price you pay for long-term returns. Fifth, they think in time frames appropriate to their thesis. If you believe we're in a multi-year precious metals bull market, you don't panic over a 3-month correction. Your time frame determines your tolerance for volatility. Sixth, they continuously update their thesis based on new information. They're not rigid. If the fundamentals change, their position should change, but they don't confuse price movements with fundamental changes. These characteristics aren't innate. They're developed through experience, study, and deliberate practice. You can cultivate them if you're willing to be honest with yourself about your decision-making process. Let's address the core thesis underlying precious metals investment, currency debasement. Throughout history, every fiat currency has eventually failed. Not some, all. The timelines vary, the specific mechanisms differ, but the pattern is consistent. This doesn't mean the dollar or euro will collapse tomorrow. It means that over time, paper currencies lose purchasing power through inflation and monetary expansion. The question isn't whether this happens. The question is how fast it happens and what you do about it. Right now, we're in a period of what some analysts call slow-motion debasement. It's not hyperinflation. It's not a currency crisis. It's the gradual, steady erosion of purchasing power that most people don't fully notice until they look back over years or decades. You can see this in the data. The purchasing power of a dollar today is a fraction of what it was in 1971, when the gold standard was abandoned. This wasn't an accident. It was policy. Governments benefit from inflation. It reduces the real value of their debt. It creates the illusion of growth through rising nominal prices. It allows them to fund spending without explicit taxation. The cost is borne by savers and wage earners who see their purchasing power decline. Silver and gold act as insurance against this process. Not perfect insurance, not guaranteed returns, but historical stores of value that cannot be printed or debased by government decree. This is why central banks hold gold. This is why sovereign wealth funds are accumulating precious metals. They understand what most retail investors miss. Over long periods, hard assets preserve wealth in ways paper assets cannot. One of the most destructive myths in investing is the importance of perfect timing. Yes, buying at $15 per ounce would have been better than buying at $91. But waiting for $15 when fundamentals suggest the market has shifted is a recipe for being left behind entirely. The investors who succeed in major trends really bought at the absolute bottom. They bought when they understood the thesis, and they held through volatility. Think about it historically. The people who bought gold in 1971 didn't buy at $35, they bought at $40, $50, $60 as it was already moving. But they still participated in a move to over $800 by 1980. The people who bought Bitcoin in 2013 didn't buy at $10, they bought at $100 to $200, $500 as it was becoming visible. But they still participated in subsequent moves to thousands of dollars. Trying to time the exact bottom is a game most people lose. It's more important to be roughly right about the direction than precisely right about the entry point. This doesn't mean you should ignore valuation. It doesn't mean you should chase parabolic moves. It means you should focus on building positions when your thesis is intact, rather than obsessing over short-term price action. Dollar cost averaging exists for this reason. If you believe silver is going higher over the next several years, but you're uncertain about short-term movements, buying consistently over time removes the timing decision. Yes, you'll sometimes buy at higher prices than the previous month. You'll also sometimes buy at lower prices than the following month. Over time, you'll average out at a reasonable entry point without the stress of trying to call tops and bottoms. Patience also matters after you've established a position. Markets test conviction. They shake out weak hands. The investors who lack patience sell at the first correction and miss the subsequent recovery. Markets move in cycles. This is one of the most important lessons in finance, yet it's one most people ignore in practice. We've been in a long cycle of equities outperforming commodities. This wasn't always the case. From 2000 to 2011, commodities broadly outperformed stocks. Before that, from 1980 to 2000, stocks dominated. Before that, from the late 1960s to 1980, commodities led. These cycles typically last 10 to 15 years. They're driven by fundamentals, but they overshoot in both directions because of psychology. Right now, we appear to be in the early stages of a new commodity cycle. This doesn't mean stocks will crash. It means the relative performance is likely to favor real assets over financial assets for some extended period. Understanding this helps you maintain perspective. When silver corrects, you can remember that corrections happen within bull markets. When it consolidates, you can remember that consolidations are normal. History also teaches us about the magnitude of moves possible in precious metals. The 1970s bull market saw silver increase more than 20-fold. That's not a prediction for today. It's a reference point for understanding the potential scale when fundamentals align. Equally important, history teaches us about the speed of corrections. Silver lost 80% of its value from 1980 to 1982. Again, not a prediction, but a reminder that these markets can be brutal in both directions. The investors who study history aren't trying to predict exact parallels. They're trying to understand the patterns of human behavior and market dynamics. that repeat across contexts. Let's talk practically about portfolio construction. Silver shouldn't be your entire portfolio. Even if you're extremely bullish on precious metals, concentration creates fragility. Most financial advisors suggest that precious metals should constitute somewhere between 5 and 15% of a diversified portfolio. The exact number depends on your age, risk tolerance, and financial goals. The purpose of holding silver isn't to maximize returns, it's to provide diversification that behaves differently from your other holdings. Stocks and bonds tend to correlate during certain market environments. Real estate has its own cycles. Silver and gold often move counter to financial assets during periods of monetary stress. This diversification is most valuable exactly when you need it most when conventional assets are struggling. Think of precious metals as insurance with upside. You hold insurance on your house not because you expect it to burn down, but because the cost of being wrong is catastrophic. You hold precious metals not because you expect currency collapse, but because the cost of monetary instability is real. Unlike insurance, however, precious metals can appreciate significantly. This makes them unique, defensive assets with offensive potential. The specific allocation should reflect your personal situation. If you're young with decades until retirement, you might allocate less to metals and more to growth assets. If you're near retirement and focused on preservation, you might allocate more. There's no universal right answer. There's only what makes sense for your circumstances and allows you to sleep at night. We've covered a lot of ground. Let me bring it back to what actually matters. You are living through a period of significant monetary and economic transition. The forces that govern markets for the past 40 years are shifting. What worked in the past may not work in the future. This creates both risk and opportunity. The risk is being caught unprepared, holding only paper assets in a period of currency instability, lacking exposure to real assets in a commodity cycle, having no hedge against inflation. The opportunity is positioning yourself thoughtfully for what's likely coming, not with certainty, not with perfect timing, but with a reasoned assessment of probabilities and risks. If you hold silver, your task is to maintain the discipline that got you here. Don't let price movements dictate your strategy. Don't let greed push you into over-leveraging. Don't let fear shake you out during normal corrections. If you don't hold silver, your task is education before action. Understand what you're buying and why. Start small if you're uncertain. Build conviction through learning, not through price chasing. For everyone, the task is emotional control. The wealth transfer happening now will separate those who can maintain discipline from those who cannot. Markets reward patience, understanding, and rational decision-making. They punish panic, greed, and ignorance. The investors who emerge from this period wealthier won't be the ones who predicted the exact price path. They'll be the ones who understood the underlying forces, positioned themselves accordingly, and had the fortitude to hold through uncertainty. This is a marathon, not a sprint. The next few years will test your conviction, your patience, and your emotional resilience. There will be moments of doubt. There will be corrections that feel like the thesis is breaking. There will be talking heads declaring the move over. Your advantage is understanding. The more you learn about monetary history, market cycles, supply and demand fundamentals, and investor psychology, the better equipped you'll be to navigate what's coming. Stay curious. Stay skeptical of easy answers. Stay focused on what you can control. You can control your allocation. You can control your risk management. You can control your emotional responses. You can control how much time you spend learning versus reacting. You cannot control daily price movements. You cannot control macro policy decisions. You cannot control what other investors do. Focus your energy where it matters. The wealth transfer we're witnessing isn't about getting rich quickly. It's about preserving and growing purchasing power over time through understanding and discipline. That's not exciting. It's not dramatic, but it's what actually works. Thank you for watching. Stay informed, stay rational, and remember, in investing, understanding beats prediction every time.